Hello, everyone. My name is Jamie Brandis, and I'm with the Colorado Small Business Development Center Network's SBDC TechSource program. I'd like to welcome you all today to the webinar, How R&D Tax Credits Could Benefit Your Business. We're glad you could join us, and we hope that you'll receive some great takeaways today. Very quickly, I'd like to introduce you to our Colorado SBDC TechSource program, designed to support science and technology ventures throughout the state of Colorado. Different from many accelerators and incubators that lead to equity funding, where you give away an ownership piece of your company, SBDC TechSource focuses especially on sources of non-dilutive capital where there's no equity given, and on technology commercialization and business development. And the federal R&D tax credits that we will be talking about today are important to our conversation about business development. Colorado SBDC TechSource is a specially designed program that taps subject matter experts such as Thierry Lepoutre today to provide you, the science and technology entrepreneurs and companies, from pre-startup through advanced second stage with direct assistance. That comes in the form of customized expert consulting at no cost to you, and through relevant workshops and events in person and online throughout the year. Topics include SBIR, STTR, and advanced industry grant proposals and compliance, technology commercialization, IP protection and assistance with the patent process, market research, market sizing, strategic and tactical planning, access to capital, and much more. A few quick things. After this webinar, if you're interested in meeting one-on-one with an SBDC TechSource specialist or attending events, workshops, or webinars, please visit our website at www.coloradosbdc.org/tech to get started. Today's webinar will be recorded, and you will receive an email following the presentation with a link to the recording, allowing you to go back and view this webinar as often as you would like. Colorado will be hosting the National SBIR, which stands for Small Business Innovation Research, Road Tour on August 16th in Boulder. You will be able to speak with representatives of many federal agencies that participate in the SBIR program, and the agenda is packed with great information. We also have an accelerator known as the Tech Venture Accelerator that starts July 12th, and we still have 2 spots available for companies based in Boulder. We will include all of this information in the follow-up email. I'd now like to introduce you to today's webinar presenter, Thierry Lepoutre. Thierry will be sharing with us for a little under 1 hour today, and then we will have time at the end to answer any questions you may have. Feel free to type out your questions during the webinar in the chat space. He will answer them at the end. Thierry Lepoutre is founder and president of Booster Consulting, LLC, which provides consulting services to help innovative companies successfully claim R&D tax credits and obtain refunds from the government. Thierry has more than 20 years of experience recovering R&D tax credits for companies in all industries, ranging from one-person startups to large multinationals. Thank you for joining us, Thierry.
Thank you, Jamie. So first of all, thank you to everyone for attending this webinar. My presentation, I expect, will last about 30 minutes, so that should give a lot of time for questions after. So I look forward to that being a part of my presentation also. So first, I'll just give a quick background on myself. As Jamie said, I have 20 years experience in R&D tax credits consulting. I previously co-founded and ran a consulting firm with 65 employees, and that was our only focus, R&D tax credits. I moved to Colorado in 2016 with my family and started Booster Consulting, and now I mainly focus on Colorado companies, helping them out. So why is this topic important? I just thought I'd put in this slide. In a nutshell, the IRS will give companies a 10% tax credit on all R&D expenses to a company performing R&D in the U.S. And in most cases, this is cash. But it's estimated, and this is the IRS's estimate, that 80% of eligible companies are not claiming, either because they don't know about it or because they think they're not eligible or they think the process is a little too complicated. What I did not put in here is of the 20% who are claiming, the majority are underclaiming because there's a number of calculations and details that are overlooked in their claims. So what I'll do today is go over the basics of the R&D program from a technical point of view. Then I'll talk about the financial and legal aspects to help you determine what is your, which projects you can claim, how much you can get back, and which ones you are allowed to claim in some more complex situations. I'll also talk about, for those who are claiming already, I will touch on the areas that can help you greatly increase what you're already claiming. So let's start quickly. What is the R&D tax credit? It's a federal business tax credit available to any company or person that's conducting R&D activities. It's usually cash. It's normally applied to income taxes. So you're paying taxes in your tax returns, and this gets applied as a regular tax credit to reduce those taxes payable. But since 2016, on top of it being applied to income taxes, for startups in the first 5 years of income generating years, even though the startup is not necessarily profitable and not paying taxes because they're spending so much on technology, those startups can use the tax credit to offset payroll taxes. So it's basically a cash refund available to just about everyone. The benefit is 5 to 10% of your R&D expenses in pure profit dollars. In most cases, it's 10%, up to 10%. You can claim the current year, the current tax year, as well as go back and amend the 3 previous tax years. So there's in some cases, potentially 4 claims going in, which add up to significant amounts. Colorado has its own R&D tax credit. There's quite a few limitations on it, and there's not a lot of companies, at least in my client base, that are eligible, but I will touch on it at the very end, one slide on it. So who can claim? C Corp, S Corp, individual, partnership, organization, trust, pretty much everyone. Except if you're a charitable or not-for-profit organization, you're not paying taxes, you can't use this tax credit. Company can be in any industry. You must conduct eligible R&D activities in a field of technology, and that I'll touch on what is an eligible R&D activity in a few slides. And finally, the R&D costs must be incurred in the US. So how do you claim? There's 4 steps. 1, identify your R&D activities, calculate your R&D expenses, fill out the form because this goes through your tax returns, and finally, prepare the backup documentation. I'll go over each one. So what's an eligible R&D activity? IRS describes it. It's a pretty broad description, but it's a 4-part test. It's got to be in a field of technology, so it cannot be in the social sciences, for example. It's got to be the development of something new in the company's field of expertise, and that's important. It's in your company's field of expertise. There needs to be a process of experimentation and elimination of uncertainty. What does it mean, that 4-part test? Basically, if you want to just get away from those 4 points and think, what does R&D mean? It's what we all understand R&D to be, which is the development of new or improving the existing products, process, or software. As I mentioned, not in the social sciences, so economics, business, arts, humanities are not eligible. So once you've said, okay, here's my R&D activities. I know I've got these different projects where I've got R&D. I'm doing experimentation. I've got my scientific team. You've identified the projects. Now you got to go and say, what are my expenses associated with that? Now, the eligible expenses come in different categories. The first and most important by far in the majority of cases is wages, okay? So for a wage to be eligible, you need to be engaged in R&D, but also the direct supervision of R&D and direct support of R&D. So you're talking about concept development, feasibility analyses, prototypes, everything related to prototypes, design and development of equipment, and the whole process of experimentation associated with those activities. So of course you've got testing, rework, final testing, testing with a client in the field, and coming back and doing modifications and rework. And essentially anyone involved with that, supporting those people or supervising those people, those are all eligible R&D wages. Okay. Now, one thing to remember too, in a lot of cases, companies have documentation giving exact, hours per project, but there's also many, many cases where you don't get that, so you need to do estimates. But in any case, if you've got an employee that's 80% or more of their time on R&D, the IRS says you can claim the full salary 100%. Okay. Next slide. Eligible expenses, supplies. So that again is common sense. The materials and supplies that are used during experimentation. So you're talking about lab supplies, test materials, experimental molds, all the pieces and prototypes, the equipment and prototypes, and scrap when you're doing experimental runs. Now, be aware that if you have capitalized items, even if they fall under those categories, you cannot claim it. That's kind of like a specific little area that because it's been capitalized in your company books, you cannot claim it as a current expense under R&D. And finally, land, property, equipment that would fall under capital are not claimable. Next is subcontractors. So the rules on subcontractors is the same as for employees. So it's got to be direct R&D, R&D supervision, or R&D support. And just one thing to know, that you don't get as much of a percentage back as for employees. But that's part of the calculation you do when you start filling out the form. And also to be aware, payments to universities and research centers generate a much higher credit. Now, there's a specific category in the R&D world which is called funded research, and this applies to, for example, majority of companies in aerospace industries or other industries where there's a lot of subcontractor payments, either by the government or by large primes, that are paying a subcontractor, which let's say is you, to do R&D, okay, to develop a component or to develop a solution. And here in this case, you are getting paid to do R&D. So are you allowed to claim your own expenses if those expenses are being covered by someone else? And so what the IRS did is develop some rules regarding that to determine who is able to claim. Is it you because you're doing the R&D, or is it the prime or the other entity, whatever that entity is, because they're paying you to do R&D for them? So it's kind of you're a subcontractor to them. So the rules on that is for the taxpayer to claim the R&D credit when receiving payment. For you to claim it when you're getting paid is, number one, you need to retain rights in the results of the research, which in my experience, you do 99% of the time. And you need to bear some of the economic risk. And that second point there is the major, deciding factor. And what eventually the IRS got to is that if you are getting paid in a firm fixed price contract, which is SBIRs, or in many cases just your typical subcontractor contract, develop this and it better works and we're going to pay you $20,000 for it, or $200,000. In a firm fixed price contract, you are bearing economic risk. whether you're profitable or not is irrelevant. The fact is you're getting paid a set amount, and whether whether you, the increase or decrease of the amount of work you put into it, it has no bearing on how much you get paid, and therefore you have the right to claim it and not that entity paying you. On the other side of the spectrum is a time and materials contract. So in those contracts, you're getting paid for every hour you spend. So if you're spending more hours, you're getting paid more. There's no significant economic risk on your part, so you cannot claim that project. So as an example here, SBIRs, the majority of SBIRs are firm fixed price, and therefore, good news is you can claim all your expenses under that SBIR contract, which includes all your own labor, as well as the materials, the expenses you have to build your prototypes that you're delivering under that contract. And even though you've itemized all those expenses and you're getting paid for it with a profit margin, it's still all yours to claim. There's other things to look at, even in a time and materials sometimes, and that's my last point here. There's some inspection and rejection termination clauses, warranties. So it might be that even in a time and material, you still have some significant economic risk, and that's something that needs to be done to look at properly to determine if maybe you do have a right to claim it. So next point is maximizing your R&D claim. So this is another area where if you're already claiming, this is an area where you can really increase your claim. What I find is in many cases, I'll start working with a client, and let's say that client has a pretty good handle on labor costs per project, and everything's looking good until we start looking at bids and proposals, and we see that there's a significant amount in there, often the owner or some other key person. And within that bids and proposals, there's all the time in that bids and proposals that is tied to those R&D projects is claimable, because in any R&D project, the bids and proposals time is not pure marketing. It's really defining the criteria and the parameters for that R&D project, which is the first steps of any R&D claim, of any R&D project. So make sure you catch that, okay? And, trying to break that down per project might be difficult, but you can certainly, come up with estimates, and that's the way it's done in most cases. Next is general and administrative. I don't know about your company, but I'd say 80% of the clients I work with, G&A is like a dumping ground for a lot of work done by people who don't know where else to put their time. And so what we find is we'll gather all the costs for the different R&D projects, and at the end, we're seeing some employees that are only at 60% of their time on those projects, and we're going, where's the rest of their time? And we see that it's been put in general administrative because it's kind of a supporting activity, or we don't want to charge the client, or it's just thrown in there just because it's the end of the day on Friday. And it's the same thing for overhead. If you have an overhead category, you need to do that reality check and say, does it make sense that my employees, if I add up all their time on these R&D projects, it doesn't add up to 100%, but that's all they're doing is R&D. Okay, so that's where you can get a lot of extra dollars. It's very significant sometimes and can add up to quite a bit of credit very quickly. Finally, internal R&D labor. This is the fourth category within a company's books. That often is not a specific R&D project. That can be overlooked. Sometimes you make sure that you're catching that time, even though it might be on 100 different small items. It's still R&D, and the IRS will certainly never have a problem with you throwing that in, even if it's not associated with a specific R&D project. Next point, prototypes, including delivered to customer. This is something that changed in the law recently. It used to be that, well, first of all, that the basic premise is that if you develop something and sell it to a client, well, that's not really a prototype anymore. It's a delivered commercial item. However, the law changed on that a few years ago. If your delivered item is still considered a prototype by the client. So for example, you're developing some component of an engine and it's delivered and you've done your part, but there's still, that client still is, it's treating it as a prototype because it still has to be integrated with the rest of the system. And you got paid for it. That's still a prototype. It's still claimable. You can still claim those material costs. This final point here, all or substantially all. If you recall a few slides ago, I talked about if an employee is 80% or more, you're automatically at 100%. Okay. Now you need to do that final check once you've accumulated. So let's say you've got 10 different projects that your company is working on. You've got 20 different employees, and then you go and kind of capture time for all your employees from the different projects. And at the end, you're pretty happy because you caught every project and you caught the G&A and the overhead, the bids and proposals, and there you go, you're putting in your claim. The final step you need to do is to look, are there any employees in those 20 employees that when you've gathered all their time on R&D projects, not including non-R&D activities, and you've got some of them at 82, 86, 91, others at 70 or 60 or 40 or 20, but all the ones that are at 80 or more, you need to change that number. You can put it at 100 now. So you've got all these employees that have their time that the IRS says, even though it's non-R&D, that remaining under 20%, you can still claim that remaining 20%. That's a step that everybody forgets to do. And that's free money just sitting there at the very end of your claim, a little adjustment. So now that we have all our expenses, we have all our R&D projects, we need to turn this into a tax credit that goes into the tax returns. So, and again, I'm talking about federally here. I'm going to touch on my last slide of the state. But the form is the Form 6765. Okay. Now, for those who've never heard of the R&D tax credit, this might sound confusing, but those of you who have already filled out this form, this is an area that you can also, and I've seen, maybe half the companies are doing this wrong. There's two calculation methods. You need to do both because the IRS a few years ago came up with what they call the simplified credit. Okay. And I see most companies using that simplified credit because it says simplified, but it's actually more complicated and brings you back less money. So you need to do both calculations, and you'll find it's a little work. You have to dig up some information on your gross receipts of the previous few years, but you'll find that there'll be a significant difference between the two, and you need to figure out what's the right one for you. Once you filled out that Form 6765, you send that to your CPA, or if you're doing your own tax returns, roll it into your tax return, and then you apply the tax credit as appropriate. So if you've got taxes payable, or if you've been paying taxes because you're profitable, that gets directly applied to those income taxes. If you've already paid your taxes, well, you're going to get a refund, and that'll happen within a couple of weeks. If you are not profitable, and as I mentioned earlier in the presentation, in the first 5 years of a startup, you can turn that credit into a payroll tax credit. And there's a few forms and there's a few steps here where you'll probably need the help of your CPA or consultant. But basically, within a few months after your tax returns, you can start applying this tax credit to your payroll taxes. So on your employee salaries, you're paying Social Security tax, and the employer portion of it is 7.5%. and you can get that refunded using this R&D tax credit. And remember, if you have not claimed before, you claim it for the current year, and you can go back and get the 3 previous tax years. And in those 3 previous tax years, if you were paying taxes, you'll get a refund for those years. It takes a few months, but it always ends up working out and coming through. Just be aware that payroll tax credit I was talking about in the previous point, that is only for current tax returns, so you cannot do that election on amended years. Backup documentation. So the only thing that gets sent in with your tax returns, you need to understand, is that one form that has, the different components of your expenses. So it says your wages, how much your subcontractors, materials, and a choice of one of the 2 calculation methods. So the IRS actually has no knowledge of what industry you're in, what the nature of your R&D projects, and you're not required to send in anything, any kind of backup in your tax returns. I have not seen an R&D audit in Colorado in the 3 years that I've been here anyways. And talking with colleagues, there are very, very few audits. However, you are required by law to do certain steps to have justified your claim. And the first step is identifying your R&D projects. So you can't just say, hey, everybody does R&D in my company, and just throw in the number right off your books. You have to have identified your R&D projects and determined that they are eligible, meeting the criteria. And that's, that can be in different forms. It can be in note form. That can be just in the documentation that you have on those projects. Or it can be in project summaries where you describe the work that was actually done. And for the financials, you need to have the backup of those financials. Again, you can't just throw in materials. You have to have identified which materials relate to what prototypes or what tests, and identify them clearly as being eligible expenses and tying them to different projects. Risk of audit is small, as I mentioned, and mostly limited to amended claims or very large claims. So how do I use the credit? I talked about this in the previous slide. The only thing, just remember, you're profitable company, you're immediately offsetting your taxes payable, or if you paid them, you're getting a refund. You're unprofitable startup, you're filling out those forms and applying it within a few months to your Social Security taxes on your payroll. If you're unprofitable and you're not a startup, you still should claim, because you can carry this forward up to 20 years. And at some point, I would expect that you're making profits and you can utilize it. You don't want to have to go back at that point and start amending. So fill it out and get those credits at least in the books. So my last slide, as I had mentioned, the Colorado R&D tax credit. So your company needs to be located in an enterprise zone. If you're in an enterprise zone, there's a number of credits available to you, and one of them is the R&D tax credit. If you know you're in an enterprise zone or you're not sure, there's a way to look it up under enterprise zones and Google it, and you put in your address and determine it. There's a number of credits available. And the credit is approximately 2%. It's not large, and it's only usable if you're profitable, so offsetting your state income taxes, and it gets spread out in 4 equal parts over the next 4 years. So just something to be aware of. I don't have a lot of clients that are in these enterprise zones, but it's a little extra, and it's not a lot of work to get it. So that's it. Thank you very much. I'll hand it over to Jamie at this point, and any questions, that you would all have. Feel free to ask general questions or also related to your specific situation. Thank you.
Thanks, Thierry. So it looks like we don't have any questions right now, but if you do, please do type them into the chat bar. We're happy to answer them. Okay, so it looks like we do have a couple questions. So that someone cut out for a while, so sorry about any of the issues that you might have experienced. So this person said they might have missed the discussion on this. They're an LLC sole owner, pays themselves by subcontracting out to a national lab in related research. The credit is most leveraged early on, right, is the question.
Let me understand that question a little bit better. Let me read it.
So they're looking to save this credit until they're spending a lot more on R&D and have more incoming capital, possibly on an SBIR.
Okay, so you're asking, I'm trying to understand the question. You're asking, can you save this credit for future years? Is that if that's the question, well, okay. Absolutely, it can be carried forward for 20 years. However, as soon as you have the availability, as soon as you can use the credit, you should be using it. So let's say you're not profitable and you're going, well, in a couple of years, our sales are going to be through the roof and we'll be able to use it. I would say if you can use it now because you do have some salary expenses, use it on the payroll tax credit because at least you're using it now and getting that refund now. One thing is that if you're an LLC, a single owner LLC, as you probably know, you cannot give yourself a salary. You give yourself payments, you pull money out of the company or in whatever other form, but you don't have an actual salary, and therefore you don't have an amount to claim under wages, at least not for yourself. If you've got some employees, that's great, but I've got a lot of clients that are taking out a lot of money, and the equivalent of what they consider a salary of $200,000 and would love to claim everything, but they can't. It's not a W-2 box one wage, and therefore not claimable. So that's kind of a hindrance for a single owner LLC.
So someone's asking, is R&D related travel included?
No. So if you go back to the slide under eligible expenses, wages, slide 8, it needs to really fall under those. So if you've got time spent, so if you look at at the time you spent on your R&D project, you're in your office and working away, and that's eligible time because it's one of those multiple points of concept development or whatever else. And then the full next day you're traveling and going over to some location to continue the R&D. Now, that day per se of travel, no, it's not, because you're not working on R&D, but nobody's paying attention to that because really you're in the plane and you're working on R&D, you're working on whatever communication related to it. So the time that you spend, you don't look at travel. You just try to consider your time overall globally. So your time is fine and claimable. The expenses related to travel itself does not fall under one of the categories that are the categories of R&D, and all expenses need to fall under one of these categories. So the first one is wages. So paying for a plane is not a wage. It's not supplies, and it's not a subcontractor that's performing R&D. So you can't claim it. And in a lot of cases, you'll arrive at a question like that where you're looking at one of your expenses and you're going, you know what, this kind of falls under prototype, or this kind of falls under some kind of category of R&D. But in the end, the determining factor is, does it fall under one of those three categories: wages, subcontractors, or materials? And there's a number of different other expenses, and I'll give you one that's been a huge point of contention, is expenses related to a patent. And that's, I still don't have a full answer on that, and nobody is really giving me a full answer, because that would fall under subcontractor, and you can say, well, that's a subcontractor expense. So technically you fall under that. And then you go look under subcontractor though, and you go, okay, must meet the eligibility requirements of doing research, R&D supervision, or R&D support. And then you go to research of wages and you go, well, it's none of those. It's actually some legal work. So that's a tough one. And you'll find yourself in situations like that, that it really needs to fall into one of those boxes. And if it does not, as much as you'd like it to, you can't claim it.
Okay, so this person is saying that they're working on a part or series of parts for a customer that they've never made before, but perhaps the customer has had another manufacturer make the part or parts before. Is it still considered a prototype because they've never made the part before?
So R&D, and it's a good point, because I don't have that in my presentation anywhere, so I will make an adjustment to my presentation. It's R&D as relates to your own business and your own company. So a part or a technology or something may have been developed somewhere else by another company, but if that knowledge is not readily available to you, and you have to go through your own steps of research and development, which is the development of the part and the experimentation, you've got a team, and you have to go through your own technical development and develop your own technology because that's not available to you, then absolutely that's your R&D to claim, as long as, remember, as long as the contract between you and that client is a firm fixed price type contract, which in this case I would assume it is, because they're asking you to develop a part, and a part is typically a cost per part, and therefore a firm fixed price type contract, and therefore you can claim those expenses. So yeah, I don't see anything wrong with the way you've just described it, as long as you're doing your experimentation, technology development, and you weren't told exactly what to do. I mean, there's some cases where a customer will say, hey, I lost my current supplier. Here, I'd like you to do this according to these specs, and this is how you do it. But typically, that customer doesn't even know how it was done in the first place, some of the details of the technology. So, yeah, I would expect you to be able to claim that, absolutely.
Okay, this person has a question about equipment. So stated that equipment can't be used for federal tax credits, but would that include structures that would be used for long-term R&D use? The example is solar array used for research and commercial profit.
So, if we talk about a solar array, okay, if you go back to the basics, so remember that this is something that gets worked on between you and your accountant too. If something is capitalized in your books, you cannot claim it. Okay, so if your accountant is capitalizing something that you've developed, you cannot claim it. However, that project that you're describing, it sounds like you've developed a solar array, and it's more or less experimental, or you're selling it to a client. So an item like that would not be capitalized, because the rules for capitalization is something like developing something, an item, or buying equipment that's going to be within your company and last several years within your company. So anything that you're developing to sell to a client, or anything that's a prototype for you, should not be capitalized, because it does not have a long-term useful value. Okay, so just so we're clear on that not being capitalized. So then next step is, okay, I've developed this product and I've sold it to a client. Okay, so if you've developed an item and spent money on the equipment and the parts that go into that item, and assuming this is an R&D project, right? It's a solar array where you've got a whole lot of R&D going on and development. And so you're already claiming your labor on it. There's no issue there. And you're getting paid firm fixed price type, so no issues there. Now the issue, and I believe this is what you're asking specifically about, I've developed that solar array, I've sold it, it's gone, and I've gotten paid for it. You can claim your labor. Can you claim the material? Now, if you recall, I mentioned earlier in the presentation that the rules used to be that as soon as you get paid for a prototype or for a product that leaves your company and leaves those doors and you got paid for it, the material expenses of that item, like that product, you could not claim, because it became part of a commercial item that you got paid for. You could still always claim the wages, because that was R&D and experimentation. The question was the materials. And that rule changed a few years ago for a special consideration, which was, hey, that solar array is still a prototype to the client. The client paid me for it, and I've done all my work, but that client is not taking that solar array and shooting it off into space. That client is working on that. It's one step in multiple steps. And if that's still a prototype to that client, then it's a prototype, and therefore you can claim it, even if you got paid for it. Okay, I hope that answers your question. If you sold that solar array and the client's like, this works perfect, and he shoots it off and is using it and is asking you, you've built some more for me, this is going great, that wasn't a prototype anymore. That became really a product for the client. Now, for a solar array, obviously, in most cases, it's going to be experimental state still, because there's so much technology development. So within a year, you'll have developed more technology. The client also will be asking for more. So I would expect in most cases that is still a prototype, but better. Those are the rules, and you apply them as best you can based on that interpretation.
Okay. So then we have a question about the Form 6765. So you would describe the standard method as laborious and generally providing less credit. So could you discuss the other method in relation to the standard method?
Okay. So it's not for some clients, one will be easier than the other. For some clients, both will be easy. It depends on the situation. So there's two methods. One method is the more traditional. Well, I'm going to look at this. I'm going to talk about the simplified, because that's the one that gets talked about more often, which is the one I was referring to. And basically, the simplified says you need to look at your 3 previous years of R&D expenses and look at how much your current year expenses are increasing compared to those 3 previous years. Okay? So if you've never claimed before, okay, and you're going, okay, I want to claim for 2018, then you actually have to go back and look at your expenses in 17, 16, and 15 and start determining what are your expenses in those 3 years. So you need to start making those calculations in those 3 previous years. And if you don't have 3 previous years, so you're a startup, you actually get penalized and get a lower percentage. The other method is a calculation that's based on previous year's R&D expenses, but also previous year's wages. So if you're a startup in your second year, and in your first year you had barely any expenses, it's very, very straightforward calculation where you'll be at the maximum amount, 10%, as opposed to if you had used the other method, you would have been at 6% refund. Okay, and this calculation just happens extremely quickly, and you had the maximum. So for startups, up to the 4th or 5th year, that more traditional calculation that was developed, and I won't go into the details of it because it was developed in 1987, and it's complex for companies that have been around for a long, long time. But for startups, it's a fantastic method of calculation that will maximize your claim.
Okay, so we have a question about deducting SBIR grants. So they actually quote a section. It's IRC section 41D4H, provides that qualified research excludes any research to the extent funded by any grant, contract, or otherwise by another person or governmental entity.
Yeah. So a project that okay, let me back up because this has been addressed before in different questions. A grant is not eligible, but the SBIR, even though they're called grants, they're actually contracts, and they're contracts for development of technology, and those are eligible R&D projects. There are some elements of the law that were written a while ago that some of the wording got used that applied to certain situations, but SBIR grants, STTR grants are allowable under the R&D, the federal R&D tax credit program. That's a certainty.
Okay, so we have more questions about travel. You might have already covered some of this, but regarding claiming travel, would going to conferences to gain insights into the market be claimable, or visiting potential customers as part of concept development or feasibility analysis?
So yeah, bids and proposals, visiting customers kind of falls under bids and proposals. So the time you take related to R&D projects that are visiting those clients and determining the criteria of those projects that end up being R&D projects. So if it never goes anywhere, you meet with some clients, but it doesn't turn into an actual project that you're working on, then no, it's not eligible. But if it ends up being a project, then that time that you spent on those projects with those clients was early stage concept development. Going to conferences technically is not, because if it's on a more marketing level, the reality is that at those conferences you're meeting with clients, you're identifying some of those projects early stage, you're learning about technology, so it falls under research. So there's elements in that conference travel that would fall under R&D work. I think that you can apply some common sense in those cases. I mean, unless you're spending a huge portion of your time at conferences, etc., most likely that it's something that happens a few times a year. and therefore not relevant. And you can apply some general estimates to your time to try to put a reasonable estimate, and then not worry too much about a daily, activities on a daily basis that may or may not fall under it. I don't think that's the purpose or the objective of the IRS in terms of tracking it at that level on a daily basis. They're generally completely fine with estimates of time. But remember, the travel expense, again, this is related to your time. The travel expense itself, hotels, planes, etc., are not claimable.
Okay, so this one is a question about developing a prototype product with R&D over the last 5 years. Due to the client's age and personal situation, they now just want to sell the IP and prototype plus plan to another company. Could they claim their time as investors? They had no employees for this R&D credit at the time that they sell the prototype.
Can you reread that question, because there's a number of different elements there? I just want to make sure.
Yep. The client developed a prototype product with R&D over the last 5 years. Due to their age and personal situation, they now just want to sell the IP and prototype plus plan to another company. Could they claim their time as investors? They had no employees for this R&D credit at the time they sell the prototype.
Okay, so whether they sell that prototype or whatever they're doing with that prototype is kind of irrelevant, because the question is about their time. Okay, so again, if it was about the material, that's a different issue, because they're selling that prototype, and then we've discussed that point. But their time, okay, so they've spent a lot of the last few years developing this technology. It sounds like it's R&D, and assuming it meets the criteria of R&D, then let's say each one of those, let's say there's 3 of them, investors or founders or whatever, you have to look, where was there a salary, like a W-2 Box 1 expense, and if so, then yeah, that's claimable as a percentage of whatever time they spent. Let's say they paid themselves $50,000, and they can claim 50,000 times whatever percentage of their time was on that project. However, and again, I don't know the corporate structure here, but if this was a few individuals and there was not a company, so they've got each their own LLC or something like that, because you mentioned investors, then if they're single owner LLCs or individuals, then they don't have a wage, like a salary W-2 Box 1 expense. So therefore, in a lot of cases like that, I find there's nothing to claim, well, just material amounts or subcontractors, but there ends up being no wage amounts claimable.
So I think you covered this before, but just want clarification. This person just graduated from a tech accelerator. Most of them have been, they've been working without pay. So since they don't have wages, can they still claim the tax credit?
Sure, materials, subcontractors, if any, but unfortunately, if you haven't paid yourself, add insult to injury, there's nothing you can claim on that aspect. So, I mean, if the point of this, although there was an adjustment to the payroll taxes, but it was always meant as a tax credit for companies. So that's why it's structured that way, that there needs to have been some payment made, some wages, and then again, if there are no wages under that company, then there's nothing to claim.
Okay. I think that covers most of our questions. If you did have a question and didn't get it answered, we do offer the consulting afterwards, and we're about at the hour mark here. So I do want to thank you again, Thierry.
Jamie, just one thing. The person who asked the question regarding, what it says in the tax code about SBIRs, and government work and government grants, feel free to set up a meeting with me to discuss it in greater detail, because that's something that does not have a clear, there is confusion there, and I've addressed it a few times in the past, and there's no real way to address it, because again, there's wording from that tax code that doesn't match the nature of the contracts that NASA or SBIR has with clients, and so it doesn't apply. But feel free to set up a meeting with me, free to talk about that in greater detail if you'd like.
Yep, as I mentioned, Thierry is one of our consultants, so we're happy to help set that up. Our website, again, is www.coloradosbdc.org/tech, and you are welcome to contact us for help with any of a number of different topics. So please let us know if we can help. Some dates to remember, again, is the National SBIR Road Tour. And if you didn't catch, SBIR stands for Small Business Innovation Research. And that is Friday, August 16th. It's a full-day event and should be great. So thanks again for joining us, and we'll see you next time.
Thank you.